If I told you that one simple mindset shift could multiply your investment returns by 10 times, would you believe me? Today, I am sharing an investment philosophy secretly used by Wall Street elites, the long-term greedy principle. Look at this shocking comparison. While short-term investors lost money over 5 years, long-term investors achieved 300% returns during the same period. The difference? One simple mental framework that I'm about to reveal to you. And stick around until the end, because I'll show you exactly how to start this strategy with just $1,000, even if you're a complete beginner. Most people think being greedy in investing is bad, but what if I told you there are 2 types of greed and only one leads to wealth? The wealthy understand something that 99% of people miss completely. They've cracked the code on human psychology and turned it into their greatest advantage. Today, you're going to learn their secret. In the next 30 minutes, you're going to discover something that could change your financial future forever. First, I'll reveal why 99% of people fail at investing, and it's not what you think. The real reason has nothing to do with market knowledge or timing, and everything to do with how your brain is wired. Then I'll break down the core psychology behind long-term greed and why it's the most powerful wealth-building mindset you can develop. Next, I'll share 7 specific wealth accumulation strategies that you can start implementing today, regardless of your current income level. These aren't complex trading techniques or get-rich-quick schemes. These are proven, time-tested methods that ordinary people use to build extraordinary wealth. Finally, I'll give you a complete implementation roadmap, step by step, so you can start your journey toward financial freedom immediately. If you want to achieve financial independence by 2025, this video is your starting point. But here's the thing, this information is only valuable if you actually use it. So grab a notebook, because you're going to want to write this down. Let's start by understanding why your brain is actually working against you when it comes to building wealth. The human brain evolved over millions of years to prioritize immediate survival over long-term planning. This served us well when we were hunter-gatherers, but it's devastating for modern investing. Your brain releases dopamine when you get immediate rewards, but struggles to value future benefits, even when they're mathematically superior. Here's a fascinating experiment that proves this point. Researchers offered people a choice: receive $100 today or $120 in 1 month. Most people chose the immediate $100, even though waiting just 30 days would give them a 20% return. That's equivalent to a 240% annual return, yet people couldn't wait 30 days. This is called temporal discounting, and it's destroying your wealth potential. Successful investors have learned to rewire this response. They've trained themselves to feel excitement about delayed gratification because they understand the mathematical reality of compound growth. Warren Buffett calls this delayed gratification, but I prefer to think of it as long-term greed. You're not giving up pleasure, you're multiplying it exponentially. The difference between wealthy and poor mindsets isn't about money, it's about time horizon. Poor thinking focuses on what you can get today. Middle-class thinking focuses on what you can get this year. Wealthy thinking focuses on what you can build over decades. When you extend your time horizon, everything changes. Small amounts become large fortunes. Simple strategies become powerful wealth-building machines. Now let me explain what long-term greed really means and why it's different from the destructive short-term greed that ruins most investors. Short-term greed says, "I want maximum returns right now, regardless of risk." It leads to day trading, speculation, and chasing hot stocks. It's emotional, impulsive, and almost always leads to losses. Long-term greed says, "I want maximum wealth over my lifetime, and I'm willing to be patient to get it." It leads to systematic investing, compound growth, and building sustainable wealth. It's rational, disciplined, and historically proven to work. The key insight is that being greedy for long-term results actually requires short-term patience and discipline. Warren Buffett and Charlie Munger are perfect examples of long-term greed in action. Buffett has held some stocks for over 50 years. He's not patient because he's a saint. He's patient because he's greedy. He wants to maximize his lifetime wealth, not his quarterly returns. When Buffett bought Coca-Cola stock in the 1980s, people thought he was crazy to pay such a high price. Today, that investment has returned over 2,000%, paying him hundreds of millions in dividends every year. Let me show you the mathematical miracle of compound growth with real numbers. If you invest $1,000 at a 10% annual return, here's what happens. After 10 years, you have $2,594. Not bad, but not life-changing. After 20 years, you have $6,727. Getting interesting. After 30 years, you have $17,449. Now we're talking. But here's where it gets crazy. After 40 years, you have $45,259 from that original $1,000. But what if you don't just invest once? What if you invest $1,000 every year for 40 years? With the same 10% return, you'd have $442,593. That's nearly $500,000 from investing, just $40,000 over 40 years. The compound effect turned your $40,000 into $442,000. That's the power of long-term greed. This is why time is more important than timing. You don't need to time the market perfectly. You don't need to find the next Amazon. You just need to start early and stay consistent. Every year you delay costs you exponentially because you lose an entire year of compound growth. Now, let's talk about the opportunity cost of short-term thinking. When you chase quick profits, you're not just risking losses, you're giving up the certainty of long-term wealth. Every dollar you lose speculating is a dollar that can't compound for decades. Every year you spend trying to time the market is a year of guaranteed growth you're missing. Now, I'm going to share 7 specific strategies that embody long-term greed. These aren't theoretical concepts, these are practical tools you can implement starting today. Strategy number 1 is index fund investing. This is the foundation of long-term wealth building. An index fund buys every stock in a market index, like the S&P 500, giving you instant diversification across hundreds of companies. You're not betting on individual companies, you're betting on the long-term growth of the entire economy. Historically, the S&P 500 has returned about 10% annually over long periods. That includes the Great Depression, multiple recessions, wars, and market crashes. The key is choosing broad market index funds with low fees. Look for expense ratios below 0.2%. My recommendation is to start with a total stock market index fund, which gives you exposure to virtually every public company in America. Strategy number 2 is value investing for individual stocks. If you want to pick individual stocks, focus on companies that are temporarily undervalued but have strong fundamentals. Look for companies with consistent earnings growth, low debt levels, strong market positions, and reasonable valuations. The key metrics to understand are price-to-earnings ratio, debt-to-equity ratio, and return on equity. Don't try to find the next hot stock. Find boring, profitable companies that will still be growing in 20 years. Think utilities, consumer staples, and established technology companies. Strategy number 3 is real estate investment trusts, or REITs. These are companies that own and operate income-producing real estate. By investing in REITs, you get exposure to real estate without the hassle of being a landlord. REITs are required to pay out 90% of their income as dividends, so they typically offer higher yields than regular stocks. Focus on REITs that own essential properties like apartments, medical facilities, and data centers. Strategy number 4 is building a high-dividend stock portfolio. These are established companies that pay significant portions of their profits directly to shareholders as dividends. The beauty of dividend investing is that you get paid while you wait for the stock price to appreciate. Look for companies with a history of consistently increasing their dividends year after year. These dividend aristocrats have proven their ability to generate cash flow in good times and bad. Strategy number 5 is maximizing your retirement accounts. This is the closest thing to free money you'll ever find. If your employer offers a 401k match, contribute at least enough to get the full match. That's an immediate 100% return on your investment. Max out your 401k and IRA contributions every year, if possible. The tax advantages of these accounts can add hundreds of thousands of dollars to your lifetime wealth. Strategy number 6 is tax optimization. Taxes are one of your biggest wealth destroyers, but they're also controllable. Use tax-advantaged accounts first. Hold investments for more than 1 year to qualify for lower long-term capital gains rates. Consider tax loss harvesting to offset gains with losses. If you're in a high tax bracket, municipal bonds might make sense for your taxable accounts. Strategy number 7 is automating your reinvestment. Set up automatic dividend reinvestment plans and automatic monthly contributions to your investment accounts. Automation removes emotion from the equation and ensures you stay consistent even when markets are volatile. The goal is to make investing as effortless as possible so you never have an excuse to stop. Let me share some real-world examples of how these strategies work in practice. Sarah is a teacher who started investing $300 per month into index funds when she was 25. She never increased her contributions, never tried to time the market, and never panicked during downturns. By age 65, her consistent investing had grown to over $1.2 million. Her total contributions were only $144,000, but compound growth turned that into millionaire status. On the flip side, let me tell you about Mike, who started with the same income as Sarah, but tried to get rich quick. He day traded, chased hot stocks, and constantly moved his money around trying to beat the market. After 20 years, he had less money than when he started, despite earning the same income as Sarah. The difference wasn't intelligence or luck, it was mindset and strategy. Here's a real portfolio breakdown from a successful long-term investor. 60% total stock market index funds, 20% international index funds, 10% REITs, and 10% bonds. Simple, diversified, and effective. This portfolio has averaged 9.4% returns over the past 20 years with minimal maintenance required. Now let's talk about the common traps that destroy long-term wealth. The first trap is trying to time the market. Even professional investors can't consistently predict short-term market movements. The best strategy is timing the market, not timing the market. Stay invested through ups and downs and let compound growth do the work. The second trap is over-diversification or under-diversification. Over-diversification means owning so many investments that you dilute your returns. Under-diversification means putting too much money in too few investments, increasing your risk. The sweet spot is owning enough investments to reduce risk without diluting returns. A total market index fund achieves this automatically. The third trap is emotional trading. Fear and greed are the enemies of long-term wealth. When markets crash, fear tells you to sell everything. When markets soar, greed tells you to buy more. Both emotions lead to buying high and selling low, which is the opposite of what you want to do. The solution is to have a plan and stick to it regardless of emotions. Risk management isn't about avoiding all risk. It's about taking calculated risks that align with your long-term goals. Diversification is your first line of defense. Don't put all your money in one stock, one sector, or even one country. Spread your investments across different asset classes and geographic regions. Your second defense is maintaining an emergency fund, so you never have to sell investments at the wrong time. Keep 3 to 6 months of expenses in a high-yield savings account. Let me summarize the 3 core principles of long-term greed. First, extend your time horizon. Think in decades, not days. Every investment decision should be evaluated based on its long-term potential, not short-term performance. Second, prioritize consistency over perfection. It's better to invest a small amount every month for 40 years than to wait for the perfect investment opportunity. Third, automate everything possible. Remove emotion and decision fatigue from your investing by setting up automatic systems. Remember this simple formula: buy, hold, reinvest, repeat. Buy quality investments at reasonable prices. Hold them through market volatility. Reinvest all dividends and gains. Repeat this process consistently for decades. This isn't exciting or glamorous, but it's mathematically proven to build wealth. The power of long-term greed isn't just about money, it's about freedom. Financial independence means having choices. It means not being forced to work a job you hate because you need the paycheck. It means being able to retire when you want, not when you have to. It means leaving a legacy for your family and causes you care about. Now I want to hear from you in the comments below. Tell me 3 things. First, what's your current investment experience level? Are you a complete beginner, or do you already have some investments? Second, what's your biggest concern about long-term investing? Is it market crashes, inflation, or something else? Third, how much are you prepared to invest to start implementing these strategies? Even if it's just $50 a month, that's enough to begin building wealth. I personally read and respond to the first 50 comments on every video, and I'll give you personalized advice based on your specific situation. This isn't generic information. I want to help you create a plan that works for your unique circumstances. If this video has opened your eyes to the power of long-term investing, please hit the like button and subscribe to this channel. Turn on the notification bell so you don't miss any videos in my wealth building series. Next week, I'm releasing a step-by-step tutorial on how to choose your first long-term stock, including the exact screening criteria I use to evaluate companies. Want my investment calculator spreadsheet that shows you exactly how much you need to invest each month to reach your financial goals? Click the link in the description to download it for free. It includes all the formulas I used in today's video, plus scenarios for different time horizons and return rates. Remember, the best time to start investing was 20 years ago. The second best time is today. Don't let another day pass without taking action toward your financial freedom. Your future self will thank you for the decision you make right now. I'll see you in the next video, where we'll dive even deeper into building your wealth building machine.